guys, welcome back. Now that we have finished with the fundamentals of price action, from the market structure to the volumes, we are all set to learn the different price action strategies that we can employ in the market under various market conditions. The first one in the list is obviously breakouts. You may ask, why breakouts? It is just that breakout trading can be exciting. The price quickly moves in your favor and makes it seems like you are riding a wave and at the same time making a hell lot of money for you. However, that being said, breakout trading is also quite painful. For example, you notice the price breaking above the resistance. Now the candles formed are big and bullish and you instantly get the fear of missing out. So you decide to go long. And as soon as you enter the trade, hoping to get a strong move up, the price does a 180-degree reversal. And before you know it, you bought the highs and now your stop loss is hit. And if you have not placed a stop loss order, you will see your account bleeding. I hope this has happened to at least some of you. This brings us to a very critical question. How do I filter for high probability breakout trades and know which are the ones to avoid? We have talked about the basic idea governing a breakout and a reversal in the 6th episode of this price action course. I want you guys to watch that video first because this video will be a continuation of where we left off in episode 6. And so, in order to understand the concept completely, watch that episode and then attend this video. Well then, a breakout occurs when the price moves beyond a certain level, not just any level, but a level of importance or an area of value. The area of value can be anything from a resistance, a support, to a trend line or a moving average. The very idea of breakout trading is entering the trades when the price momentum is in your favor. However, no system in the stock market is perfect. Keeping this in mind, let us first discuss the positives and shortcomings of a breakout trade. I will explain its pros and cons. First of all, let us talk about the pros of a breakout trades. Breakout trades comes with a limited risk, which means that in many instances, breakout trades present themselves during the consolidating market phases. So the initial stop losses that we place for our trades may be relatively small according to the compression or the price range used for the market entry. So in addition, a confirmation of a trade's failure may come very rapidly, which offers an opportunity for a quick exit, which simply means that if the trade does not go in our favor, the price will reverse immediately and hit our stop loss. We don't have to wait a whole day for the trade to complete. And also, the risk to reward associated with breakout trades is much better so that you can control your stop loss accordingly. The second advantage is that the momentum is in your favor. If a breakout trade is successful, large gains are possible. So getting in on strong trend early can be a profitable situation. And the third advantage is trade management, which means that the market entry and exit are predefined with the stop losses and profit targets being identified before the trade. So that our only job is to place the stop losses and targets and wait for either one of them to get hit. Now talking about the disadvantages, number one is false breakouts. So false breakouts are a considerable part of the breakout approach of trading. No matter how sound your methodology used in identifying the breakout is, or how good your system is in quantifying the market, in many instances a signal may appear to be solid, but it will end up lacking the intended participation or the increased participation from the market participants, which is the most essential thing for a breakout trade to succeed. The second disadvantage is associated with opportunity cost. The optimal breakout setups don't occur frequently, so searching for setups can often leave a trader on the sidelines instead of pursuing other opportunities in the market, or simply the number of breakout trades are less or it is hard to come by. Before venturing into different breakout trading techniques, it is always better to understand how not to trade breakouts in the first place. Let us talk about instances when you should avoid trading breakouts. First of all, under no instance you want to be trading breakout against a trend. Now trading against the trend is quite illogical for me as a trader, and you don't want to do this in the first place. We have all heard the famous saying, a trend is your friend until it bends. So let's see why trading with the trend puts you in a much more favorable position than going against it. When you are moving with the trend or in the direction of the trend, the moves that you get are pretty strong and it can last for longer period compared to someone who wants to trade against the trend. For example, let's look at the bull traders who are going long in a bearish market. Look at these up moves or corrections that are resulted from trading against the trend. So these are up moves which are very sharp and very limited. You can see that the strength of the bulls is very weak compared to the bears from the size of the candles formed. So if you are looking to trade against the trend, then you can see that there is not really much of a strength in the move, or the move is pretty weak, which in turn means that the gains from these trades are pretty much limited because you are trading against the trend. Likewise, if you want to trade breakouts, I would strongly discourage, or in fact I will strongly advise you not to trade against the trend. And let's say you are looking to trade the breakout higher. I would say the chances are this breakout isn't going to go very far because after all you are trading against the trend. What is likely to happen in this situation is that even if you get a breakout, it would not trade any higher before it will collapse lower, which will give you a false breakout at that point. So you have to be beware of trading against the trend, whether you are trading breakouts, pullback, or whatever entry technique you are using. Trading against the trend is not usually the ideal situation for you as a trader. Moving on, you don't want to be trading a breakout when the price is far from the market structure. We have talked about the market structure in the second episode of this price action course. The important thing that I have to tell you is whatever market you are looking, be it bullish or bearish or whatever time frame, be it swing time frame or intraday time frame, the principles we are discussing are essentially the same and it applies to all of them equally. Whether it is a 4-hour time frame, a daily time frame, a weekly time frame or hourly time frame, they're all the same. Nevertheless, what we are looking at right now is an uptrend. At this point in time, you see that the price has traded at a point which is so high. And some of those FOMO traders will look at this chart and decide to get long before the price trades any higher without them. So they enter long at a high price over there. Now what's the problem with going long at this high price based on the example? Think about this. Where are you going to put your stop loss? Or in other words, where is the logical place for you to put a stop loss? The possible answer is the previous resistance level with a possibility of it becoming a support if the price drops down. The level is the one that you need to lean against to place your stop loss. And of course, you don't want to be placing the stop loss exactly at the level as well because the price could just come into the level and bounce higher after hitting your stop loss instantly. So the chances are you need to put your stop loss somewhere below the resistance, because in this case the price has to move at least an equal distance as that of your stop loss so as to achieve at least a 1:1 risk to reward. As you can see, having a large stop loss gives you a poor risk to reward. So I would discourage you to trade breakouts when it is far away from the market structure because of the fact that you need to have a very large stop loss and it gives you a very poor risk to reward as a result of it. Now that we have understood what not to do, we are ready to learn the different techniques of breakout trading. There are two things to bear in mind when you have to identify a high probability breakout trade. They are you want to trade with the trend or trade in the direction of the trend. And secondly, you want to trade near a market structure or an area of value. Now let me explain each of them in detail. Let's start with the trend trading breakout strategy. So trading with the trend is something which you should be familiar by now, because earlier I discouraged you from trading against the trend, and it only makes sense to be trading with the trend. Now here's the deal. For an intraday trader or a swing trader, let us say, in a strong trend, the price tends to stay above the 20-period moving average. So if you are waiting for a pullback to the moving average or even a trend line, then most often or not you will be disappointed as the market will continue making new highs without you able to initiate a long trade. The thing is that there is a time for trading pullbacks, but it's definitely not when the market is in a strong trend. We will discuss the pullback trading systems in the upcoming episodes. Right now, in this scenario, you want to trade breakouts instead of pullbacks. This type of breakout trading strategy is called as the trend trading breakout strategy. Here you can either trade the break of the swing high or swing low depending on the type of the trend the market is in. Let's see how this works with an example. Let's say the market is in a strong uptrend and the market respects the 20-period moving average. The idea of this trade is to buy the breakouts above the swing high. You can see that the price has consolidated and broke higher. The price looks like forming a flag pattern. Then you could possibly trade higher from it. In this case, the trend is in your favor. So the ideal thing is to trade the breakout in the direction of the trend. Here you will increase the odds of the trades working out in your favor. The exact entry for this trade would be the candle above the breakout candle high. The next thing that you have to do, exit when you're wrong. This refers to your stop loss. In other words, you want to ask yourself, at which point on the chart will I get out of the trade if the market moves against me? As a guideline, your stop loss should be at a level where, if reached, will invalidate your trading setup, which simply means that keep your stop loss at a level which you think will invalidate the breakout trade that you have taken. So in this case, set your stop loss 1 ATR below the swing low. If you don't know about what ATR indicator is, watch this video on ATR indicator, or else you can simply place the stop loss below the trend line or even below the 20 moving average for that sake. Now the second exit is when you're right. On the flip side, what if the market moves in your favor? How would you exit your trade? It is simply about setting the targets. My suggestion is to ride the trend for all it's worth, which means there is a good chance of the price heading even higher. For an intraday trader, place your target as the next potential high point or the swing high, which is actually difficult to identify, or it can even be the nearest resistance level. But for a swing trader, I would ask you to ride the trend and exit the trade only if the price closes below the 20 moving average or when the market breaks out of the structure. By the structure, I mean uptrend in this particular case. That is, when the market stops forming the higher highs or higher lows is the time to exit the trade. So you can place a similar entry and exits for a downtrend with proper modifications. Moving on to the second strategy, which is trading near the market structure or an area of value. Earlier we have discussed that when the price is very far away from the structure, it doesn't really make much of a sense because your stop loss is so large and you will get a very poor risk to reward. But what if you are trading the breakout when it is near the structure? In this example, you can see an area of resistance. Resistance in a market, as you may know, is an area where there will be potential sellers coming in or where the supply is higher than the demand. Now the price tested the area of resistance and the price break and closed above it. This is a breakout of resistance, which is slightly different from the breakout of a swing high as we have discussed earlier. Because resistance is a much more respectable area in the chart, so the probability of the trade success in this case is higher. Now if you are looking to get long right now, where is the logical place to put your stop loss? The possible answer would be below the previous resistance turn support. You can put the stop loss somewhere below the previous resistance. So this is a much tighter stop loss. With a much tighter stop loss, it gives you a better risk to reward because the price does not have to move a lot in your favor to start giving you the gains. And why do you think you have a much tighter stop loss? It is because you are trading much closer to the market structure. So compared to the earlier example where the structure was too far away, it does not really make any sense to make a trading in that scenario. Now, identifying when to trade is as important as knowing how to trade. The breakout trade near a market structure can be classified into three types. Number one is breakouts with buildup. Number two is higher lows into the resistance level. And finally, number three is the lower highs into the support level. Let's start with the first one, that is breakouts with buildup. Now, buildup is basically a congestion or consolidation or a tight range near an area of value. You can think of a buildup along these lines. A lot of traders will look at the prices consolidating at the resistance. These traders go short at the resistance or somewhere in the middle of the range, and they will place their stop loss above the resistance. That's what they will do because at the resistance it makes sense to go short. But think about this a little deeper. If the price is consolidating at the resistance, what does it really tell you? You know that resistance is an area where there are potential sellers who will come in and push the prices lower. But in this example, the price is consolidating at the area of resistance. So where are the sellers? Why aren't they pushing the prices lower? And why is that? The reason why the sellers are not pushing down could be one of these two things. Either there are no sellers out there who are interested in selling, or there are equally strong buyers at the resistance. No matter what the scenario, whether it is number one, there are no sellers, or number two, there are equally strong buyers, it does not look good for traders who are looking to short either way. And on top of that, the clusters of stop losses above the resistance level would create an incentive for the smart money or the big players to actually break out higher, so that they can leverage the stop losses to take the market above the resistance. So my point is that when you see a consolidation at a resistance, basically a build-up just in front of the area of resistance, this is a sign of bullish strength. In this scenario, I'll be looking to go long, and my trade entry is when the price trades above the breakout candle high, and I will put my stop losses below the resistance level, that is below the low of the build-up or consolidation, or you can even keep it around 2 times the ATR value below the resistance. Now talking about the targets, my target would be the next nearest structure, in this case the next nearest resistance level. Now look through your charts, look through in the price approaching the support area, and ask yourselves what happens if there is a consolidation at the support area, and what will you do? Comment down below. So build-up is a core concept whenever we trade breakouts. However, there are variations of it. For example, when you see higher lows into resistance, it is a sign of a strength or weakness. Now think about it. When you see higher lows into resistance, what does it tell you? It tells you that there is not enough selling pressure, or the sellers are weak. It also tells you that there is strong buying pressure which supports the higher prices. And the final thing to keep in consideration is that there are buy stop loss orders which are clustered above the resistance, which are kept by those sellers who went short at the resistance level. And clearly this is a sign of bullish strength. Now you might be familiar with this chart pattern called the ascending triangle pattern. So if you spot such a pattern in the market condition, it means that the market could break out higher. Right? It's the exact same scenario here. You should be looking to go long in this case. The entry should be above the breakout high, and your stop loss should be slightly below the last higher low to the resistance level. And finally, your target for the trade should be the next nearest resistance, or it should be equal to the length between the first higher low level and the resistance level projected above the resistance level. Now let us look at a situation of a breakdown. This is the inverse of what you have learned earlier. So whenever you see lower highs into the support, it tells you 3 things. Number 1, there is no buying pressure, or the buyers are weak. Number 2, there is strong selling pressure pushing the price even lower. And number 3, there are sell stop loss orders clustered below the support level which are kept by the buyers who went long at the support. Now clearly this is a sign of weakness in terms of buying. And you might be familiar with this chart pattern called the descending triangle. So if you spot such a pattern in the market, it means that the market could break down lower. In this case, we should initiate a short trade below the breakdown candle low after the candle closes below the support level, just for confirmation. The stop loss can be kept above the last lower high into the support, or it can be 2 times the average true range value above the support level. And finally, talking about the targets, in this case, target should be the next support level, or it should be equal to the length between the first lower high level and the support level projected below the support level. Moving on, let us look at a highly profitable breakout trade scenario. Now here's the thing, the market is always changing. It moves from a range to a trend, from a trend to a range, etc. The longer the market stays in a range, the harder it breaks. This is true, but why is it true? Because the longer the market is in a range, the more orders are placed in the market. Let me explain. The bullish traders will put buy orders above the resistance, hoping to catch the breakouts. Similarly, the bearish traders will look to short the market at the resistance, and they will have their stop loss, which is also a buy stop loss order, and they place it above the resistance. And as the time passes, you will get an overwhelming amount of buy stop loss orders above the resistance level. And by some chance, if the market manages to break out of the resistance, it will trigger all of these clusters of buy stop loss orders, which will fuel further buying pressure, and in turn it will take the market higher. So if you want to identify explosive breakout trades with high profitability, you have to pay close attention when the market is in a range for a long period of time, because the longer it is in a range, the harder it breaks and the more profitable you become. Now that is episode 8 for you guys, and I hope everything makes sense to you. It's equally important for you to backtest these techniques and see if it works for you. If you have learned something new today, then please do like this video and kindly subscribe to the channel for the upcoming episodes. I will see you guys with the next episode.